Hello and welcome to another episode of the Investing with IBD Podcast. It's your host, Justin Nielsen, and I am here in Las Vegas. We just wrapped up a money show, one of the first money shows I've been to in a while, and it's February 19th, 2025. So I actually got here on the holiday and spent my President's Day here. So it was really fun to see a lot of folks in person. It's been a while since I've gotten out there and met people, so really appreciated meeting a lot of you. And hey, someone who knows his way around a money show, we have on as our guest this week, Harold Morris. He is one of our senior product coaches, and man, Harold, it's we've been working together for a while, 20
Yeah,
years
yeah,
plus. Yeah,
yep,
so
20, yeah,
so yeah, you've been to some money shows and events in your day.
quite a few money shows.
Quite a few, yes.
Yeah,
So,
quite a few
yeah,
of them.
yeah. But one of the things that is great about Harold, for those of you that don't know him, he is one of our most patient and thorough coaches on our MarketSurge team and a lot of the premium products. He does a lot of coaching sessions, teaching people how to use our products, whether it's MarketSurge, Leaderboard, Swing Trader, the paper, you name it. And of course, he is a panelist weekly on the IBD Live show. And usually, what we do is we count on Harold to give us some option trades. He likes to do spreads a lot. And so I love having him on the show to kind of go through some of his spreads. And again, you're so patient and in the way you explain things, Harold. I think it really helps out a lot of our customers. And that's why I love having you on to kind of go through your spreads, because at the end of it, a lot of times it seems, hey, this is simple, this is doable, this is, it's just numbers, right?
Yep,
You have your routine, and all you have to do is follow it. So
yep.
awesome
It's
job with that.
just like anything else. The more you do it, the better you get at it.
Uh-huh. And now, how long have you been trading options?
Options, doing it consistently. I started back in 2013, but it's only been like the last 6 to 7 years where I just been trading options on a regular basis.
Hmm. And why did you make the switch?
I was just curious about options. I'd heard about them, uh, about the leverage part of it, how you don't need as much capital, so it's a little bit more
Hmm.
capital efficient. And I just, okay, well, let me look into it, and this might be something I want to add to my methodology as far as trading is concerned.
Hmm. And if I remember correctly, you did a lot of kind of educating of yourself with Tasty Trade videos and
Yeah,
stuff.
that
Yeah.
and my very first exposure was with John Carter
Oh,
with
John Carter, right. Hmm.
yeah, with simpler options, and
Uh-huh.
took a few of his courses, and then yeah, I do I've taken some from Tasty Trade. I
Tasty
think it's
Trade.
different name, but Tasty
Yeah,
Trade.
yeah, it's
Yeah,
it's it's gone through some different versions. Tom Sosnoff, he is just a serial entrepreneur, so
yeah.
he of course came up with Thinkorswim, and then
Hmm.
and we've had him on the show. We'll have to have him on back again, and maybe John Carter too. So, well, let's dive into it a little bit. So, of course, options, two options that you have, calls and puts, and for each option,
Oh, I think Justin has frozen up. Sure. So yeah, Justin looks like Justin has frozen up. He is in a hotel room doing this webinar, so he started to explain what is an option, and in particular, a what is a spread trade or a credit spread. The type of trading I like to do is got several names. So it's called a credit spread. It's called, I actually wrote them down. So first off, it's a bullish position. So you're looking for price appreciation. And a credit spread can be known as a put credit spread, a short put spread, a bull put spread, or sometimes I might just say I'm selling a bull put spread. So they're all the same trade, they just have different names. And basically, what you're doing is you're selling a put and then you're buying a put at a lower strike for protection. So, for example, maybe you're going to sell the 100 put and then you're going to buy the 95 for your protection. So that's what's called a $5 wide spread. And then your whatever you pay for that spread, that's going to be your risk. So you take the $5 wide. Let's say you paid $3 for the spread. So $3, so it's a $5 wide spread. You paid $3 for it. So your risk in the trade is $2 even. In option terms, we always multiply by 100, so it's $200. That's what I really like about spread trading is your risk is defined and your potential profit is also defined. So these spread trades are considered risk defined trades because before you get into the trade, before you start putting money to work, you know what your risk is and you know what your potential profit is. And so again, it looks like Justin, are you back here?
I am. So went from the
Okay.
hotel Wi-Fi to my iPhone hotspot. So
Okay.
hopefully
Okay.
this we might have to pause the upload to just make sure that we're not straining my system here on the phone. But yeah, thanks for covering, Harold.
Sure.
This is what a
Sure.
live.
So yeah, yeah, this is live, so these type of things happen. So we're not,
Yeah.
we don't
So how
we
far
don't
did you get?
rehearse
Did you
this
get through
stuff.
the did you get through the call to put the buy and the sell side?
Well, I just explained first off what a credit spread is, and it just got different names. You know, the bull put spread,
Hmm.
selling a credit spread. So the same trade has got multiple names, and sometimes there can be some confusion about that. I
Hmm.
also mentioned that it is a risk-defined trade. So before you get into the trade, you know what your profit is, you know what your losses are. So it's risk-defined. So you know what you're looking at before you get into the trade, and then that's when you came back and that's where we are. So we'll
Yeah.
just pick up from there.
Well, and do we need to kind of step back a little bit? So did you explain what a call is
No, I did
exactly?
not.
Yeah,
I
so
did not go
let's
in
do
there.
that just real quickly. So a call, of course, is it gives you the option, not the obligation, to either buy, to buy a company or stock at a certain strike price with a certain expiration date. So we're going to talk a little bit about how you choose those strike prices and expiration dates, and then the put side is just the opposite. It gives you the option to sell, but not the obligation to sell a stock at a certain price by a certain time. So those are the two ways in which you can, the two options you have in terms of what you use in terms of contracts. But then, of course, you can either buy or sell them. So when you're
Mhm.
dealing with credit spreads, you're you're basically net, you're coming up with two different ways in which you're doing it. Um, but one is giving you more premium, one is giving you less, and then at the end of the trade, you're actually coming up with a net premium, right, for the
Right,
credit
right,
spreads.
right,
Yeah.
right.
And how is that better sometimes to have that credit as opposed to being a buyer?
Well, I first when I first got exposed to options, started talking to people. I talked to two people. Both of them were traders on the CBOE, and I met these two gentlemen at two different times, and they both said, "You want to be a seller of options. Don't be a buyer. You want to be a seller." So I said, "Okay, I'm going to listen to these people. They're very successful, had decades of experience. So that's what I do. So I sell. I'm selling premium,
Hmm.
and so I don't do much buying of options. You know, that's when people think of options, that's the first thing they think of is, okay, well, I'm going to buy a call on this stock here, and I'm going to buy a call and see what happens.
Right.
Me personally, I like the put side where I like to sell a put. The
Hmm.
put has got some advantages that the call doesn't. One of those advantages is time. Okay,
Right.
as the one thing options have that individual stocks don't have. Option does have an expiration, whereas if you buy a stock, you can hold it indefinitely, but an option,
It'll work
it's got
eventually,
yeah,
I hope.
yeah, you hope, yeah,
Yeah.
but
But
an
yeah,
option,
if it
it's
doesn't
got
work in your expiration date,
right.
there's nothing you can do. It just
Right, and
expires
that's one of the
worthless.
things you have to consider when you're putting together an option trade. There's time involved,
Hmm.
and what time you choose. That's something that you have to make a decision. Now, me personally, when I'm considering time in an option, whether it be a naked option, which I rarely do, or a spread, I like to go 45 to 60 days out. So
Hmm.
I like to give myself time. It's time for that trade to work. So that 45 to 60 days, that's that's my sweet spot.
Yeah, and it should be mentioned that time becomes really important as you get closer and closer to that expiration date. For those that are familiar with the Greek terms and options, you lose theta, right? Time
Right.
decay, and it really accelerates when you're in those last 30 days. So, is there a time in which you're like, okay, I I mean, if you're a seller, time decay is working in your favor, right? As
Right.
time goes on, you're you're doing better because the option is less valuable, and for you as a seller, that's in your benefit, right?
Exactly.
You want
Exactly.
the option to deteriorate. In fact, the ideal situation is that it expires worthless because that means you keep all of the premium.
Right. Right.
Yeah.
Yeah. So, and that's one of the difference between a put and a call is that what the time
Hmm.
for an option is called theta decay, and that
Hmm.
time works in your favor as a seller of premium.
Right. And look, you're going to have that time decay on both the call and the put,
Yeah.
but it
Yeah.
depends on how you're using it, right? When you're the
Correct.
seller, it works in your favor. When you're the buyer, it works against you. Now,
Right.
uh, let's talk a little bit about implied volatility because that's another thing that is a big element in the premium for an option. So sometimes you will have a very high implied volatility ahead of like earnings events, things
Hmm.
like that, where there's a little bit more uncertainty. It could go either direction, and by a large amount, and you don't know how much or what direction. But um, do you take implied volatility into consideration? Because again, if you got a high implied volatility and you expect it to go lower, that's also another way in which you would benefit as a seller of premium.
All right. All right. So if I'm looking at an option chain, and you can see it, how that implied volatility, the numbers increase, and it might be a large increase. That's telling you that there is some type of binary event that's coming up. Usually it's earnings. And that's when I'll look and say, okay, when is earnings due for the stock here? And in most cases, I stay away from it because I don't want to be in the stock during earnings. And I'm that way, whether it's an option or or I'm buying the shares. So I tend to avoid earnings, and during earnings season, like we're still in the latter end of earnings seasons, I tend to do a little bit more ETFs because earnings is not an issue with an ETF.
Hmm. That's a very good point. Again, ETFs give you a little bit more diversification, and again, not
Yeah.
so much the single stock risk. Let's go into an example. We'll kind of shift gears here and go into a few examples so you can walk us through this with some real live trades. So maybe we start out with five below. The ticker symbol here is FIVE, and I'm going to have Harold share his charts just because I don't want to tax my system anymore. And I'm already kind of at a disadvantage. I'm using like towels in order to kind of prop my laptop up to get the right the right level. So Harold, go ahead and share your screen, and
All
you can
right.
walk us through this
And
five below trade.
all right, let me share my screen. Give me a second here. And then screen.
And so you'll go to share. Yeah, there we go. You got it.
Okay, so you can see Five Below.
Yes, perfect.
Okay, so this is Five Below. Now this is a trade because of the market. It was a bearish trade, and
Hmm.
because of the market, I haven't been doing too many bearish trades on any stock because the trend is your friend, and we are trend traders, trend followers here. So the trend has been up, but back in December, I was looking at Five Below, and you can see the moving averages here. This black line is a 200-day moving average. So I'm on a daily chart. This black line is a 200-day. So this is back in December, actually December 31st, when I was looking at this trade here. So that's right over here on this bar here. This is December 31st. Now,
Hmm.
it was already a little bit below. It already touched that 112.60 area and pulled back. But you can see it done it one time here, one time there, and I was expecting it to do a third time, which it did right over there. So I was looking at the where is it? Lost my date there. So December 31st. Now, what I did with this stock is I looked at the delta. So when I first thing I'm looking at, okay, my short put. Okay, I like to look at least the 30 delta as far as my short put. And if you're familiar with delta, well, the definition of delta is for every $1 move, the option is going to move
Every one
in
dollar
that
move in the
direction. So,
stock.
right. So every
Yeah.
$1 move in the stock, if it's a delta 30, the option is going to move 30 cents.
Hmm.
That's the mathematical definition of delta. But
Hmm.
I tend to use delta as two ways. I use it as my share equivalent or the probabilities. So with the delta 30, that means it has 30% chance of expiring in the money. Well, as an option seller, you don't want it to expire in the money. We want to sell expire out of the money. So that means it has a 70% chance of expiring, or probability of success at 70%. So that's what I was looking at back on December 30th, December
And just so
31st.
for
So
people that, just for people to understand, like when you're dealing with, at the money, those are
mhm,
usually your 50 delta, which means
right.
you've got a 50-50 chance, that going in the direction you want it to, 50-50 chance it goes in the direction against you. And again, when you're dealing with calls, if you're long, you kind of want the stock to go up. If if you are looking at a put, you want the stock to go down, and vice versa. If you are selling a call, you kind of want the stock to go, go down. And if you're selling a put, you would like the stock to go up. So in this case, you've got a bearish trade. So you want the stock to go down. So in this case, you chose to start with selling a call. Is that right?
Yeah, selling a call, right.
Mm-hmm.
And I was looking at my notes. So I sold, it was the 115 call,
Mm-hmm.
and it was a Delta 34 at the time of the trade.
Mm-hmm.
So, and again, you want to be your deltas around, it's going to be approximate. You're not going to get exactly delta 30, but I like to be in, the delta 30, delta 40 in that range. I even go down to 20 occasionally, but I like to
Mm-hmm.
stick to around the delta 30. So back in December, it was a delta 34. I sold the 115 call and I bought my 120 for protection. And then,
Okay,
so
I'm going to stop you real quick. So
okay,
you chose the 115 based on the delta, but it just so happened that that was kind of at a level that you wouldn't expect the stock to go above, right?
right.
I mean, it just so happened. I mean, 112.60 is your previous high. That's where it got, you know, turned away at the 200 day. So it's kind of it's kind of nice that it kind of matched a level in which you would be looking at anyway, right?
Yeah, yeah.
Yeah.
So you
So
see
okay.
I've got my cursor. You can see the 115 is, a little bit above where that 112.60 is. You can see on the right side of
Hmm.
the chart, the green, that's the 115 area. So this stock could have actually gone up to that level and it'd still be profitable.
Hmm.
So I sold the 115, about the 120, and that was on
And you
December
said the 120
31st
for protection,
for
right? So
protection. Yeah,
so let's
right.
talk about that a little bit because if you just had sold the call, then what is your risk?
Your risk is to the down or to the upside there. So if
Which
this
is
stock
unlimited,
at
right?
right, it's unlimited. So if it started to go up, then you didn't do anything, then that trade is working against you. But
Hmm.
if you put your protection on, so you're buying a call, so you're selling a call and you're buying a call, that's
At a
your
higher strike
protection
price.
at a higher strike price, correct?
Hmm.
So
Yeah.
that's where your protection comes into play.
And so you
And
chose the 120. And was that
right.
just because it was 5 points, or was it because of the delta?
It was because of the 5 points. I like to do $5 wide spreads. So I looked at, okay, 115 was the strike I was looking at to sell the put. Excuse me. To sell, I'm not sell the put, but sell the call. And I like to
Hmm.
go $5. So I went to the 120, and then I look at what my credit is. So my credit at that time was $1.30. So I said,
Hmm.
okay, I like that. $1.30 is the credit received. So that's when I put the trade on. And then I actually sold it on January 2nd. So um, right around, it was, just a few days later that week, because
Okay.
December 31st, if I remember correctly, that was a Tuesday. And then January 2nd, a
Right.
couple of days after the new year. So I just sold it a few days later. And that was a 27% profit. Now, one of the rules I have is if the trade is up 30% or more, I like to take profits in the trade. This was
Hmm.
up around 27%, but we were coming into the new year, and I just didn't want to, because during that New Year's week it's light trading, and then when we get to the new year, the first trading day of the year, nobody knows what's going to happen. So I just said, okay, let me just lock in this trade, lock in that 27%. You know, just a few days in the trade, that's some good money. So I took the money and basically took the money and ran.
Yeah. And look, I mean, 27% in 2 trading days, right? I mean,
Yeah.
you got it on the 31st, closed on the 1st, 2nd, so 3 trading days maybe that you held it if you got off on the 3rd. Now, another option, another thing here is, okay, you got a $1.30 credit. That means for every contract, you have the potential of getting $130. That's
Right.
if you held it through expiration and it was below 115.
Right.
So when you're taking profit at 27, 30%, you're just taking a fraction of that, right? And so some
Right.
people might argue, well, gosh, that's like hardly any money at all. So what makes it worth it?
Well, it's a high probability trade. Okay, so
Mm-hmm.
that's another great thing about spread trading is the probabilities are high. Yeah, you might if you look at some of the numbers. And this is something I get asked where, okay, well you're putting up, you're risking X amount, but you're only making this amount, and is it worth it? Well, the reason why I do that is because it is a high probability trade,
Right.
and these trades tend to work very well, and that's the attraction to them.
Yeah.
You just have to do a lot of them to really make it really pay off.
Do one contract. If you,
Right,
based on
exactly,
what your risk
exactly.
tolerance is, you might say, oh, hey, I can risk $3,000 on this trade, and that means, oh, okay, I can do close to 10 contracts,
Right,
and that means you're looking at a profit potential of a lot more. Instead of $130, you're looking at $1,300. So
right.
again, nothing says you have to do one contract. We often talk in terms of one contract, but you do multiple contracts. Now, do you ever get into a situation where you've got a liquidity problem because you want to do, maybe 5, 10 contracts and, uh, you know, it's hard to get your order filled?
I have run into that, but that's the way to avoid that is to make sure the stock has got liquidity. So you can start by just looking at the average daily volume, which is here.
Yeah.
Okay, so that's a good place just to start. But then once it's got some good liquidity, then that's where you got to look at the option chain, look at the calls. I mean, excuse me, the bid and the ask. I like to
Mm,
see no more than a 10% difference between the bid and the ask. So if I got that 10% or less between those two numbers and it's a liquid stock, usually it's not a problem getting out in and out of the trade. But even there have been times um, where I did have something liquid and the bid ask was pretty tight and I just couldn't get out. And I just had to close out the trade at I was at a loss anyway. What I remember this was TLT some months ago,
mm-hmm.
and I just couldn't get out. Even though it's a very liquid product, I just couldn't get out in time, and came close to being assigned the shares, but I got out.
Mm-hmm.
Uh, the broker will allow you to sell those shares.
Yeah. So again, just to kind of wrap up this trade, Five Below, you had a 130 profit potential. The risk was maximized at $370 because you
Mhm.
take the you know, 5 strike difference, 5 point strike difference, subtract the premium received, and that gets you your
Your
risk.
risk
So
in the trade, and this is something we do that I do at least every once a week on IBD Live. So if you don't have
yeah.
IBD Live, uh,
Of
here's a good
course, you can
place
get
where you
that
can
at
get a free option trade.
investors.com/IBD Live. And also, I should mention that we do have options content on investors.com.
Yeah,
Gavin McMaster, today it was a long-term covered call on Shopify. So he does a lot of spread trades as well.
yeah.
Harold, let's
And
flip
and
this up.
that
Oh,
article is a very good article. So
mm,
those of you who are looking for education, that is a real good place to, if you're just getting started, or even if you're experienced, that's a
mhm.
real good article. It's short and to the point. That's what I really like about it, and it's a good
Yeah.
educational article on investors.com.
So let's go ahead and flip this the other way. So this is an example which, again, you said you don't, especially in this market environment, you haven't been doing very many bearish trades, but it
Right.
does show you the flexibility of, hey, whatever direction you think it's going to go, you can play that direction. And I should also say that, um, in this case, what was it, 112? The price of the stock was around 112 or a little bit less than that. The reality is, if the stock went down, you would win. If the stock
Mhm.
went sideways, you would win. The
Right.
stock could actually have gone up 3 points and you would still win. There were just a lot of ways to win with this trade, right? And that's what you said, high probability of success.
Yeah. Yeah. And
Hmm.
that's the beauty of these spread trades. You got what I call some wiggle room. You
Hmm.
don't have to be exactly right. The stock can go nowhere and you still make some money on the stock.
Yeah. Let's flip it the other way. What about when you're bullish? How do you handle that? And I think you have an example to show us.
Okay. Well, we want to do the SMH trade earlier
Or
today.
no, let's do Amazon
Oh,
because
the
this is one
Amazon.
that didn't work out, right?
Oh,
And
yeah.
you had to sell
Okay.
it for a loss.
Okay.
So
Yep. So let's
let's do
pull in
that one.
Amazon, AMZN. So this was Amazon, and it was on the 12th, so February 12th, which was um, right there. So I was playing the bounce off the 50-day. So you
Hmm.
see the 50-day, that's right there. You can see the alert that I've got there, and that alert got triggered. And I thought, okay, I'm gonna take that trade into Amazon, hoping that it was gonna bounce off that. So with Amazon, I sold the 220 put. This was a bull put spread. So this is a I'm looking for price appreciation. So I sold the 220 put, and then I bought the 215 for my protection. Now, I use the technicals when I'm looking to get out of the trade. And if you see Amazon, so on the 12th, which is right there, that's when I put the trade on. It was only up one day. And then once we got below the 50-day, that's the red line here, that's when I say, okay, this trade is not working. So I ended up selling it today. It was at a 17% loss there. So um, I'm out of Amazon, and this trade is over with. But this is one that doesn't work. But you have to have sell rules. Okay, no
Hmm.
matter how you're trading, whether it be you're trading the option or the shares, you must have sell rules.
Yeah. So wait a minute. So you said 220 was the strike you chose, right, to sell
Right,
the put. So
right.
this is still at 226. How'd you take a loss? What happened?
Yeah, I sold the 220 and I bought the 215, and um, yeah, that's interesting. Yeah,
Well,
because as
you know
long as
what
it stays
happens
up,
sometimes. Yeah, what happens sometimes is, look, the implied volatility can change. You got a little bit of theta decay. You've got a little bit of price change. So what was the price change from where you initially bought it?
I didn't look at that. So if you look on this day here, so it closed
Hmm.
at 228.93. And
Hmm.
then it was actually this morning when it was sometime later today that the stock closed, or that I actually sold it, because
Hmm.
I was looking at my P&L. That's what I was going by. What my P&L was telling me, and it was
Hmm.
telling me before the open it was down like 13%, and then
Hmm.
today it started going down even further. So I said, let me just get out now. I want to keep my losses small. Doesn't
Hmm.
matter. Again, if you're trading the shares or an option, you got to keep your losses small. So I just said, let me just get out of it, and
Hmm.
uh, then I move on. So I'm done
Yeah.
with this trade. I'm down with it, and down on it. So I'm done with it. I move on and look for something else.
Yeah. And it's worth reminding people that with options, you're not using necessarily a 7%, 8% stop loss,
Right.
right? Why is
Right.
that?
Well, options just are much more volatile than individual stocks.
Hmm.
You can go especially a stock like Amazon, that can go 7 or 8% in minutes.
Yeah.
And even if you own the shares, it can easily do that in a day. So this is, but to answer your question, options are a lot more. There's a lot more swings in an option trade.
Yeah.
So your stop loss is going to be wider. So
Yeah.
17% is not that bad. I'll let it stock. I'll let it go down to 30%.
Hmm.
Uh, but position size is always extremely important.
Yeah. And it's worth mentioning that, okay, the 220 level, you know, if 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 it if it was that was the level that you were looking at for it to stay above, that's at expiration.
Right.
So that's another thing that people need to know is, okay, it's at 226 now, and how did you take a loss? Well, you weren't at expiration yet, right? There's a
Yeah.
lot that can
Yeah.
happen in between that time. So that's worth remembering. And also, this is where the spread between that bid and ask can matter because, hey, you can be down 7%, 8%. If you've got a wide spread, you know, you can be down 10% just as soon as you buy the option or
Right,
sell the option if there's a wide spread. So,
right,
you know,
right.
do keep
So,
that in mind.
right.
Um, I want to cover a little bit. Did you have anything more on this trade that you wanted to kind of share?
No, it didn't work out. So
Yeah.
sell it and move on.
Yeah, and again, these are short trades a lot of times that you're doing, and you can do a lot of them. You can, again, you might say, oh, well, it's not that much money, but if you're doing, you know, a few $100s here, a few $100s there, and it's over 3 days, 5 days, you know, that can start adding up to, you know, some decent compounding of returns.
Yeah,
Again, as
yeah,
long as you're keeping those losses small.
and that's what's been happening in this market, because we have been going back and forth.
Hmm.
It's been a lot of volatility. So some these trades they're either working out right away, almost right away, or they're not working out almost right away. So
Hmm.
I haven't been in a trade for a very long time because of the volatility that we've seen in the market here.
Yeah. Well, let's shift to the market real quick because I think it's worth kind of remembering the type of market we've been in and why you may have been favoring credit spreads a little bit more. If we pull up the NASDAQ, of course, we've been talking about how on December 18th, we really had that kind of pretty sharp drop. We had another sharp drop in the NASDAQ at least with the DeepSeek tariffs. There's just been a lot of stuff hitting the markets. But it's been interesting because sometimes, like on you know, the day of DeepSeek, January 27th,
Yeah, right there.
as ugly as that was on the Nasdaq, down 3%. You know, if you looked at the S&P 500, it was down less. If you looked at the equal weighted S&P 500, it was up that day. So, what's been kind of your take on the difference between your market weighted averages when you're looking at the indexes and kind of your average stock right now?
Yeah, I mean, I look at those things, but I'm not making any trading decisions based on what's performing well. So RSP, as you mentioned a moment ago, on that deep seek, I can't
Hmm.
say it, but on that day, that was January 27th, how it outperformed. So I don't look and see, okay, well, what can I find that that's outperforming on that day? So I'm looking almost looking at everything, trying to find a particular trade. So I don't look to see, okay, well, if RSP is doing well, that maybe mean that maybe there's some NYSE stocks that are setting up because many
Hmm.
of those stocks are you know, they're not uh, that's telling you that when RSP is doing well, then there's a lot of participation in the other sectors. So maybe the tech stocks got hit because of the deep seek, but there's other stocks and other industries that are doing well.
Hmm.
Software did happen to do well on that particular day. Was it IGV is the
IGV is a software ETF. So you did mention how sometimes you like to do the ETF as opposed to individual stocks with some of these trades. And so, yeah, IGV was doing great,
yeah.
you know,
So yeah, so
shortly after.
it was down on that particular day, but you can see the notch where it closed. So it had
Hmm.
a very positive close. What was it in the right at the 50%? So
Hmm.
anything higher than 40%, we consider that a bullish sign for a stock on a particular day or week.
Hmm. And so how much is the market kind of coming into play when you're making some of these decisions on individual trades? Is it is it a lot more important to kind of see what's happening with the individual stock and choose your option strikes from that and your trade?
I yeah, yeah. So I will take into consideration the market because that's what growth stock investing, the William O'Neill type investing is all about. You know, we know that stocks follow the trend of the market, so it's very important to know what that trend is. So I start there, and then I start looking for trades. And as I mentioned a moment ago, you know, or did I mention? I don't remember. If you look at the S&P, you know, we and then look at a weekly chart, you know, we up until today, we really haven't gone much anywhere since the 1st of December. You know, we
Hmm.
had this level of resistance here, and we've this week so far we're breaking out. But I don't look at this here and I say, okay, well, I'm going to change my strategy. Only thing I'm going to change is what's working. So if you know the AI stocks aren't working, then I'm not going to be looking at those stocks.
Hmm.
IGV, as we mentioned a moment ago, software, that is working. So your what's the software enterprise, that industry
Yeah,
group
software
stocks
enterprises.
we're doing pretty
Yeah.
good in that particular space.
Hmm.
So it's just all about market awareness and being engaged in the market and looking for setups there. So yeah,
Hmm.
the market does take you have to take it in consideration, and you do have to you do have to recognize, okay, when is there rotation in the market? We saw that clearly on January 27th.
Yeah. Um, so because you're a market surge product coach, and because you're using options, I want to have you kind of share maybe a screen of yours because again, market surge is a very powerful screening tool. What's kind of one of your go-to screens to get ideas for your option trades?
Well, the first one I do like to use is the Growth 250. So
Hmm.
I can go to Open Stock Ideas, Weekly Review, and we have this list here called the Growth 250. So that's what I go through on my weekends. We call it a weekend routine because, as you can see, it is 300 stocks. Now, I
Hmm.
tend to, uh, let me get one of my columns here. This is my column layout. So I'll sort it by the composite rating,
Hmm.
and I want to get the 99s at the top, and then I'll just start with the first stock, and then hit my space bar, just looking for potential stock ideas. So
And so
that's
you're basically, are you looking for basically breakouts on the bullish side and
yes,
resistance at moving average lines on the bearish side?
right. So
Hmm.
I'm looking for
Probably not going to see too many bearish ones on the growth 250
exactly
though.
right,
Yeah.
right. So
Yeah.
it's still the growth. So as far as the stocks, I'm still using the O'Neill, growth stock strategy, strong fundamentals, strong
Hmm.
sales, earnings, profit margins, institutional sponsorship. So those things don't change, even though I'm trading options here. I'm not all options. The majority of my portfolio is individual stocks, but
Hmm.
the approach is the same, whether you're trading options or looking to buy the shares. Still need to see strong sales, strong earnings, profit margins, sponsorship, etc. So
Hmm.
Growth 250 is what I like to look through, and then I can hit my space bar on my keyboard and then just go from stock to stock. So
Hmm.
that's one screen. It's a built-in screen. Well, let me just go back to it real quick. And then there's a little description as to what the Growth 250 is. So if you got some ideas as to what this screen is all about, and it is a screen of the market, and each one of these lists have that same little description here. While we're here, I like looking at this weekly report of stocks approaching or at new highs.
Hmm.
It's a good list to look at. I also like to look at the number of stocks that are on the list. So you can see as of last Friday's close, so this list gets updated on Fridays. So as of last Friday's close, there were 272 stocks on the list. At the beginning of the year, it was like at around 145, somewhere around there. So
Oh,
this list has been
big
growing.
difference.
Yeah. So this is telling you that you look at the description, this is stocks that are within 5%, um, but at 52-week highs or trading within 5% of a
Hmm.
52-week high. So
Hmm.
that's telling you that stocks are doing well. So when this list is growing. So I use this as a secondary gauge as to what the market is doing. And
Hmm.
there are some good potential stocks here.
And it should be it's worth mentioning that there are also some other general market indicators pages that you can pull up on MarketSurge. A few of my favorites are GMIAA, GMIAB, and then the
Oh,
NASDQ and NYS, what, no, NYEXG. Um,
oh, you see what I did
oh, you can't
here?
do it
I
on a
typed in
weekly,
the
yeah.
symbol, but I'm on weekly.
Yeah,
So
you got to be on
we get
daily, yeah.
calls like that. You got to be on daily here.
Yeah, and I get tripped up on that every time too. I'm on a weekly chart. I'm like, what do you mean it's not working?
Yeah,
Yeah, it takes me a minute.
yeah.
So yeah, so some of those again, here's an advanced decline line on the
Hmm.
NYSE. To your point, looking a little bit stronger on the NYSE as opposed to if you look at GMIA it's been a little bit more problematic, a little bit more of a downtrend
Yeah,
on the Nasdaq. But also, I like looking at that NASDQ. Uh, to your point, kind of gauging how many new highs there are versus new lows. I like that I like that this shows kind of where it's at. And there's been a lot of, on the Nasdaq at least, it really has been kind of a while since the new highs have trended, nicely
Yeah.
above the new lows. So again, that does give you information, but it seems like it's getting better, as you
Yeah.
noted, by that screen going from, what was it, 145 to 272 or something like that.
Right.
So,
Right.
um, to kind of wrap this up, also, I want to get to one more example, and it's an ETF, SMH. How do you go about finding ETFs? Because the Growth 250 doesn't show that. So, what do you do in terms of screening to find ETFs that you might want to do a trade on?
Well, here in the market surge, I do have a list of ETFs that I like to trade, and SMH is one of my favorites there. So it hasn't been, as you look at the chart here, it's been after that January 27th, or this is January 27th. Where is it? Well, anyway, you can see that gap down right there. So it doesn't matter what date, that gap down was not good. So SMH was not something I was looking at. It
That
wasn't
was January
until
27th. I can tell you right now. That's Nvidia getting
Oh yeah,
hammered.
here we go. Yeah,
Yeah,
right
yeah,
there.
right.
Yeah.
Yeah,
Mhm.
yeah.
Yeah, so that's that deep sea um, news over the weekend. Uh, so I wasn't looking at SMH. I was looking at other things because this wasn't working here. But
Hmm.
technology is something that I always gravitate to. At one time, I did work in the high tech industry when I lived up in Silicon Valley, so it's something I always gravitate to. So I'm always looking to see, is there a possibility with this ETF. So
Hmm.
as I was looking the last couple of days, I was saying, okay, yeah, look, the RS line is improving. It's above the moving average for the RS line. And then this was, a couple of days ago. So now we're up above the moving averages. So you got the 10-day and the 21-day. We're already above the 200-day and the 50-day. So you have that convergence of the major moving averages. So we're above that. So this is what attracted me to this trade today. So here's where I go into my option chain, and again I look at uh, 45 to 60 days out. I like to use the monthlies because the monthlies have a lot more liquidity.
Right.
As you asked me earlier, that okay, well, how do we? I forgot your exact question, but um, you know, liquidity. You want to have a liquid ETF or stock, and then the bid ask. You want to make sure that's tight. I like to see less than 10%, and then what was the other thing? I lost my train of thought. But anyway, this is a very liquid ETF, something I've traded many times over the years here. So once we got above the convergence of the moving averages, and then first thing I did, I went to my option chain. I wanted to see where is the delta there. So the delta 30, and I didn't write that down. This is a trade that was placed earlier today on IBD Live. I ended
Hmm.
up selling the 245 and buying the 240, and then I took in a credit of $1.55. So that was earlier today, and had a pretty good move. So the stock is up 14.52% so far,
The
and
option is up that
yeah,
the
yeah.
spread
I
is up
mean,
that
yeah.
much.
Excuse
Yeah.
me. Yeah, the
Hmm.
option
Hmm.
is,
Yeah.
but
If the ETF was up that much, yeah, you'd be yeah,
yeah, I'd
looking
be,
good.
yeah, absolutely,
Yeah.
absolutely.
Um, yeah, so again, you've shown two ways to do that directional. So again, I'm assuming that here in this case, this was the bull put spread again because you were going
Hmm.
bullish on this,
Hmm.
selling the put, getting a lower strike price for protection, um, and you mentioned 45. Because Susan was asking in the YouTube, how far out do you sell those spreads? You're looking 45 to 60 days, and
Hmm.
then you know, another question that came in was how do you handle spreads at or near the money in less than 5 days till expiration? My understanding is you don't play in that game.
No, no.
Yeah.
I
So,
look at 21 days to expiration and I'm making decisions. Sometimes I'll let it go a little further. If I get a little, maybe I'm down on a trade a little bit, I may say, well, let me get it go. But 21 days, that's my line in the sand. So if I'm down on a trade and maybe I started out 50 days of expiration, now I'm at 21 days of expiration. The trade hasn't worked. It's had plenty of time to work, so I'm just going to get out, maybe
mhm,
take the loss and move on and look for something else.
yeah, makes sense. Now, just one final question, because again, the 21 days, especially when time is working against you, and you're buying premium, and like doing the opposite if you were doing like a bull call spread, I could see that that time would really be working against you. But since time is working for you, why do you do that 21 days? Doesn't it get even better for you as you get closer to the expiration?
Yeah, it can, but the old expression, bulls and bears make money, but pigs get slaughtered.
Yeah,
So if I'm in the trade and I'm making money on it, I just found that 21 days expiration, that works. So
yeah,
I just, good or bad, right or wrong, that's the decision. That's my rule that I use, and I like to stick with that. It's something that's worked. And Mike mentioned it earlier on IBD Live this morning. Having a rule is better than no rules at all. So
yeah,
that is my rule, 21 days expiration. And I will give it a little bit more wiggle room, but I'm pretty strict when following that 21 days expiration. I'm not going
hmm
to try to, especially if it's profitable, you try to squeeze a little bit more out. And as we talked about
yes,
earlier, how options are a lot more volatile. And there's nothing worse, nothing worse feeling where maybe you're up 20%, it's 20 days expiration. You just said, okay, this stock looks good. And then a day or two later, yeah, you might still be up on the trade, but maybe you're up only 14% or
yeah.
15% where you're once at 20%. So,
Yeah. And
uh,
and as you said, options can move fast, and so sometimes you might find with that much of the time decay left, you're you're holding out for an extra 20 cents,
yeah,
25
yeah,
cents, and you can lose it all, kind of
yeah,
very quickly, holding out
mhm,
for that last 25 cents, and then before you know it, you're down $2, and it's like, oh, what, why, for what, so
mhm,
yeah, you
mhm.
do have to keep that in mind, especially when you're doing the selling of premium, that as you get closer to that full potential profit, it's okay to just take it before you get the full amount. So,
Yeah,
um,
yeah,
Harold, I'm going to have you stop your screen share, and I want to just thank you again for coming on and again walking folks through your process. Again, everyone has to kind of find their own process and what works for them, but at the at at the start of all of your trades, you pick the stock first or the ETF, and your levels there, and then you kind of build the option around it. So you're using that same system, you're just using it with a different methodology of how you're going to profit from it. So
right, right.
yeah, thank you so much for sharing your thoughts on that, Harold. Appreciate it.
Sure, sure. Thanks for having me.
Absolutely. That's going to wrap it up for us this week. Thank you for thank you for hanging in with us as I was dealing with some technical issues. The internet just dropped, so I'm going to be at home next week. So looking forward to being in my home office and doing it from there, and in the stable conditions. And also, it's going to be great to be welcoming a new guest onto the show. She's someone that we've had on IBD Live before, but I'm really excited to introduce her to our audience. Her name is Viva Jha, and she is been on the leaderboard in the top 10 on the U.S. Investing Championship a number of times. She's walked through on IBD Live how she uses leveraged ETFs. We just had Will Rind on and from Granite Shares, and she's going to talk about how she uses leveraged ETFs. To really kind of take advantage of market moves, and it's going to be great to kind of get her thoughts on that, and again, a new guest for everyone to learn from, so I'm excited about that. Hope you join us for that. It's going to be Wednesday, live at 5 p.m. Eastern, as it is every week. Thank you so much for joining us this week, and we will be getting this show up for the archives, as we always do. Thanks for watching. See you next week.